It's election day in Georgia as voters head to the polls to cast their ballot in the state's Senate runoff election between incumbent Democrat Raphael Warnock and his Republican challenger Herschel Walker. Now, while Democrats have already secured enough seats to maintain their razor-thin majority, there is a lot at stake for both parties. Our next guest says that the outcome from the 2022 midterm election is a gridlocked Congress for the next 2 years, and a divided government usually reduces any prospects for major changes in economic policies. Well, with us now is Beth Ann Bovino, S&P Global Chief U.S. Economist. Welcome back to the show. So I first want to get your take, because a lot of people were wondering what was going to happen with the midterms, what this gridlock will actually mean when you have this high inflation background and a lot of economic policies that Biden still wants to push through.
Well, we see it as a gridlock Congress usually means less red tape. Businesses often like that, meaning that there won't be some major policy that could disturb what markets are looking for. However, at times like this, when we have unprecedented, uncharted territory, U.S. and at S&P Global ratings expectations is that we're going into a recession. You'd like to have some policy compromise. We see a gridlock Congress as something that means that not much will get done. Very few of the Biden proposals will likely get through. We think probably the Inflation Reduction Act will probably be the last for the next 2 years.
There is one key issue a lot of people have been looking at, and that is this fight over the debt ceiling. I mean, how significant a market risk do you see that as we look ahead to a potential fight between both sides?
Well, we think for them, we also believe that you need to have, let's say you've got the debt ceiling, and you also have the government shutdown. The U.S. government has been there before. They know how markets have responded to this, as well as the population at best, as well. And there is a sense that the frustration with the constituents on this back and forth among policymakers may have already sunk in. Of course, the threat is there. We can't ignore it. But let's hope that a government comes to its senses and backs away.
And obviously, we're still watching to see what the Fed does. They're not pivoting anytime soon. But when you have inflation this high, you also have a lot of stickiness still in the labor market. How much does that complicate the picture for next year?
Well, that's one of the reasons why we see a recession in our forecast, although albeit it's a shallow recession. It's largely a story of a classic overheating of the U.S. economy. You have inflation coming down slightly, but it's still near that 40-year high and about 2.5 times where the Fed would like it to be. And when we look at core inflation, that's one thing. The Fed has been incredibly aggressive. They say they're slowing down. I don't know if they're going to be able to. I think the worry is if they slow down too soon or too fast, they're going to just have to speed things up going forward. The concern that I have overall, and one of the reasons why we see inflation as being a challenge, and as you mentioned, sticky, we saw that in the jobs report. We saw wage gains up 5.1% on a year-over-year basis, something that the Fed does not want to see. But the worry, of course, is even with those big fat paychecks, in terms of when you adjust for inflation, it's in negative territory now for 20 straight months. So ultimately, nobody's happy, and the Fed needs to contain these pressures.
And Beth Ann, really quickly, I mean, that jobs number that we got last week certainly is kind of revived questions around, how significant that labor market or declines in the labor market need to be in order for inflation to cool down. You talk about the wage pressures there, but when we're talking about job losses, we got more reports today of other companies cutting. I mean, how much more of that are we likely to see in order to bring down the overall inflation rate?
Well, there's two things that suggest in our mind that if the U.S. does go into recession as we expect, it'll likely be a shallow one. First, households and businesses are still holding on to, pretty relatively healthy savings. Now, this is an aggregate number, so it really depends where you are on the income spectrum, but that is one support. Onto your point about what businesses will do, keep in mind that job openings they've come down, but they're still incredibly robust. So we would expect that businesses businesses would first get rid of basically the jobs they may have available that they're trying to fill, put a freeze on those, and so that means they'll still be able to hold on to some of to their workers. We do think that there is a challenge there, and we do think in our forecast we do see the unemployment rate climbing higher. We see it getting to around 5.5 or a little over 5.5%. So that does mean a squeeze for some workers. But overall, we see that some of the cushion in the economy so far suggests that we won't see certainly those ugly numbers of an inflation rate at 14 or even 15%. We're looking at 5.5 best.
S&P Global Chief U.S. Economist Beth Ann Bovino. Good to have you on the show today. Appreciate your time.
Thank you.